You have been lied to about inflation your entire life. Every economist, every politician, every news anchor has told you the same story. Inflation happens because the government prints too much money. Print more money, prices go up. Simple cause and effect. Except that is complete garbage. And the proof is everywhere if you know where to look. The Federal Reserve has printed trillions of dollars over the past 15 years. Trillions. And yet inflation stayed low for over a decade. Then suddenly, in 2021, prices exploded. So what changed? If printing money causes inflation, why did it take 10 years to show up? And why did it show up right when global supply chains collapsed and energy prices spiked? Here is the truth they do not want you to know. The story that printing money automatically causes inflation is propaganda. It is a convenient lie that protects the wealthy while blaming poor people and government spending for rising prices. The real causes of inflation are way more complicated and way more profitable for those at the top. And once you understand how this lie benefits the rich, once you see who actually profits from keeping you confused about inflation, you will never trust another economics lesson again. Let us start with the basics. What actually is money printing? Most people imagine literal printing presses churning out dollar bills. Stacks of cash being created out of thin air. And while that does happen, that physical cash represents almost nothing compared to the real money creation in the economy. The vast majority of money is created by private banks when they make loans. Not the government, not the Federal Reserve. Private banks. Every time a bank approves a mortgage or a business loan or a car loan, they create new money electronically. They do not need to have deposits first. They just create the money and the loan at the same time. This is how modern banking works. And it happens billions of times every single day. So when people say the Federal Reserve is printing money, what are they actually doing? They are creating something called bank reserves. These are special deposits that banks use to settle transactions with each other. The Fed creates these reserves out of thin air and uses them to buy government bonds or other assets from banks. This is called quantitative easing. The bank sells bonds to the Fed. The Fed creates reserves to pay for them. The bank now has reserves instead of bonds. That is the transaction. Notice what did not happen. No new money went to regular people. No cash got deposited in your account. The transaction happened entirely between the Federal Reserve and private banks. The composition of bank assets changed, but the total amount did not. Now, before we go deeper into why this matters and who benefits from the inflation lie, if you are tired of economic fairy tales designed to protect the wealthy while blaming everyone else, hit that subscribe button right now. This is Money Trap Channel. We are exposing the real mechanisms that transfer wealth from working people to financial institutions. We show you how the economy actually works instead of the simplified nonsense they teach to keep you confused. Subscribe, because what comes next will completely destroy the story you have been told about inflation since you were a kid. Here's the critical part. When the Fed creates reserves and buys bonds from banks, those reserves cannot leave the banking system. Regular people and businesses do not have reserve accounts at the Fed. Only banks do. So, when people say the Fed printed $5 trillion, they are technically correct. But that $5 trillion exists as bank reserves. It cannot directly enter the economy to bid up prices on groceries or gas or rent. The banks that receive these reserves can use them to make more loans if they want. But here's the thing. Banks do not make loans because they have reserves. They make loans when they find creditworthy borrowers who want to borrow. Having extra reserves does not change that calculation. This is where the inflation story falls apart. From 2008 to 2020, the Federal Reserve created trillions in new reserves through quantitative easing. Trillions. And inflation stayed below 2% for most of that time. Sometimes it was barely above 1%. If printing money automatically causes inflation, this should have been impossible. We should have seen massive price increases immediately. But we did not. Why? Because the money stayed in the financial system. It inflated asset prices. Stocks went up. Bonds went up. Real estate went up. But consumer prices stayed relatively stable. The wealthy got richer as their assets appreciated. But regular people saw minimal inflation in the prices they actually pay. Then 2021 happened. Suddenly, inflation spiked to levels not seen in decades. And immediately, everyone started blaming government spending and money printing. Too much stimulus. Too much quantitative easing. The government gave people money during COVID, and now we are paying the price with inflation. This narrative spread everywhere. But notice what it ignores. In 2021, global supply chains collapsed. Factories shut down. Shipping costs exploded. Energy prices spiked because of geopolitical issues. Entire industries could not get the parts they needed to produce goods. Demand was high because people had savings from the pandemic, but supply was constrained. More money chasing fewer goods. That is inflation. But the money printing story is simpler. It puts the blame on government, on stimulus checks, on helping poor people. It completely ignores the supply-side disruptions that were actually driving prices up. And it ignores the corporate profits. Because here is what really happened during the recent inflation spike. Corporate profit margins hit record highs. Companies were not just passing along costs. They were raising prices far beyond what their costs increased. They were using inflation as cover to jack up prices and boost profits. This is called greedflation, and it is well documented. But nobody wants to talk about it because it disrupts the narrative. Let me give you an example of how this works. Imagine there are only 5 loaves of bread available in your town, and 5 people each have $10. Bread costs $2. Everyone can afford bread with money left over. Now suddenly the government gives everyone an extra $10. Everyone now has $20. But there are still only 5 loaves of bread. What happens? The price of bread goes up. People bid against each other. Bread might go to $4 or $5 or even higher. More money chasing the same goods equals inflation. This is the standard story, and it makes sense in this simple example. But now change one variable. Imagine that instead of 5 loaves of bread, the bakery can make 10 loaves. They have the capacity. They have the ingredients. They can scale up production. Now, when everyone gets an extra $10, what happens? People want to buy more bread. The bakery produces more bread. Supply increases to meet demand. Prices might go up a little bit as the bakery adjusts. But you do not get runaway inflation because supply can respond to demand. This is what actually happens in a productive economy with slack capacity. More money does not automatically mean inflation if production can increase. And here is where it gets really important. For most of the past decade, advanced economies have had tons of slack capacity. Unemployment was elevated for years after 2008. Factories were not running at full capacity. There was room to produce more without driving up prices. This is why quantitative easing did not cause consumer price inflation. The economy could absorb the increased demand without supply constraints. But when COVID hit, supply chains broke. Suddenly we did not have slack capacity. We had shortages. And that is when inflation showed up. Not because of money printing that happened years earlier, but because of supply shocks happening right then. Now let us talk about who benefits from the money printing narrative. When you blame inflation on government spending and money printing, you are really blaming fiscal policy. Fiscal policy is government taxing and spending. The stuff that actually helps regular people. Stimulus checks, unemployment insurance, infrastructure spending, social programs. All of this requires government spending. And if you convince people that government spending causes inflation, You can cut all those programs. You can say we cannot afford to help people because it will cause inflation. Meanwhile, what do you never hear about? You never hear about cutting corporate subsidies. You never hear about raising taxes on the wealthy. You never hear about regulating corporate price gouging. The inflation narrative serves a political purpose. It protects the wealthy and their profits while cutting programs for everyone else. Think about who owns the assets that appreciate when the Fed does quantitative easing. Rich people. Who owns stocks? Rich people. Who owns multiple properties? Rich people. Who benefits from low interest rates that drive up asset prices? Rich people. But when consumer prices go up and hurt regular people, suddenly it is all about money printing and government spending being the problem. Not corporate greed. Not supply shocks. Not monopolies raising prices. Just money printing. And here is the really insidious part. The solution they propose for inflation is always the same. Raise interest rates. Cut government spending. Basically, create a recession to bring prices down. Who gets hurt in a recession? Working people lose their jobs. Small businesses close. Poor people suffer. Who benefits? The wealthy buy up assets at discount prices. They consolidate power. They come out of the recession even richer. This is not a bug. It is a feature. The system is designed to use inflation as an excuse to transfer wealth upward. Let me show you the historical evidence. After World War II, the United States had massive government debt, way higher as a percentage of GDP than it is today. The government had printed money to fight the war. According to the money printing theory, we should have seen massive inflation after the war ended. But we did not. Why? Because productive capacity increased dramatically. The economy grew. Manufacturing expanded. The debt as a percentage of GDP shrank without ever being paid off because the economy grew faster than the debt. This is what happens when you invest in productive capacity instead of just giving money to rich people. Compare that to what happened after 2008. The Fed created trillions in reserves, but that money went to banks. It inflated financial assets. It did not go to productive investment. It did not build infrastructure. It did not create jobs. It just made rich people richer. And when inflation finally did show up in 2021, it was not because of what the Fed did in 2008. It was because of supply shocks in 2020 and 2021. But the narrative ignored that. It blamed money printing from years earlier because that narrative serves the wealthy. Now, let us talk about the countries where money printing actually did cause hyperinflation. Zimbabwe, Venezuela, Weimar Germany. These are the examples everyone points to. And they are real. But notice what they have in common. These were not cases of central banks doing quantitative easing in productive economies with slack capacity. These were cases of governments printing money to cover budget shortfalls in economies that were already collapsing. Zimbabwe printed money because their agricultural production collapsed after they kicked out experienced farmers. Venezuela printed money because their oil-dependent economy collapsed when oil prices fell and they had no other industries. Weimar Germany printed money to pay war reparations while their industrial capacity was destroyed. In every case, the inflation happened because production collapsed, not because money printing alone caused inflation. If your economy cannot produce goods, then yes, printing money will cause inflation. More money chasing fewer goods. But if your economy can produce goods, if you have slack capacity, if you can increase supply, then printing money does not automatically cause inflation. It can actually help stimulate production and growth. This distinction is critical, but it gets ignored because the simple story is more useful for propaganda. Think about Japan. Japan has been doing quantitative easing for over 20 years. They have printed massive amounts of money relative to their economy, and they have struggled with deflation, not inflation. Prices have been falling or barely rising for decades, despite aggressive money printing. Why? Because they have demographic issues. Aging population, low demand, high savings rate. The money they print does not translate into increased spending on consumer goods. It just sits in the financial system. This completely contradicts the money printing equals inflation story. But nobody talks about Japan when they are fear-mongering about inflation. Or look at the United States between 2008 and 2020. Trillions in quantitative easing. Inflation averaged below 2%, sometimes below 1%. The Fed was actually trying to create more inflation and could not do it. They had an inflation target of 2% and consistently missed it on the low side. This should have been impossible if money printing automatically causes inflation. But it happened because the relationship is way more complicated than the simple story suggests. So what actually causes inflation? Multiple factors. Supply shocks are huge. If a pandemic shuts down factories, prices go up. If a war disrupts energy supplies, prices go up. If climate change destroys crops, prices go up. Monopolies and corporate concentration matter. When a few companies control an entire industry, they can raise prices without competition stopping them. We have seen massive corporate consolidation over the past few decades. This gives companies pricing power. Expectations matter. If everyone expects inflation, they demand higher wages and raise prices preemptively. This becomes self-fulfilling. Demand matters. If everyone suddenly wants to buy houses at the same time, housing prices go up. Money supply matters too. But it is just one factor among many. And it only causes inflation if the other conditions are right. The problem with the simple money printing story is that it ignores all of this complexity. It gives you a single villain: government spending, money printing. And conveniently, the solution is to cut programs that help regular people while protecting corporate profits and wealth. This is not economics. This is ideology disguised as economics. And it has been incredibly effective at shaping public policy in ways that benefit the wealthy. Here is what they do not want you to understand. When the Fed does quantitative easing and buys bonds from banks, it does not create inflation in consumer prices. It creates inflation in asset prices. Stocks go up. Real estate goes up. Bonds go up. This makes wealthy people who own assets richer. But it does not help regular people who do not own significant assets. In fact, it hurts them by making housing less affordable. So the Fed is printing money. But it is printing it in a way that specifically benefits the rich. And when consumer price inflation shows up due to supply shocks, they blame government spending and cut programs for the poor. See how this works? The inflation narrative is a trap. It is designed to make you oppose government policies that could actually help you while supporting policies that benefit the wealthy. It makes you think that helping poor people causes inflation, that raising the minimum wage causes inflation, that government spending on infrastructure causes inflation, when really, those things can boost productive capacity and reduce inflation in the long run. But corporate monopolies raising prices? That is just a free market. Corporate profits at record highs? That is just efficient capitalism. See how the narrative protects power. And here is the scary part. This narrative has been so successful that even people who should know better repeat it. Progressive politicians talk about how we need to be careful about government spending because of inflation, as if spending on social programs is the same as corporate subsidies or military spending, as if the government budget is like a household budget and we need to tighten our belts. This is exactly what the wealthy want. Austerity for the poor, unlimited support for the rich, all justified by fear of inflation from money printing. The reality is that a government that controls its own currency cannot run out of money the way a household can. It can always pay its bills in its own currency. The constraint is not money. It is real resources. Can the economy actually produce the goods and services we need? If yes, then the government can spend money to mobilize those resources without causing inflation. If we are at full capacity, then yes, more spending could cause inflation. But that is a question about real productive capacity, not about money supply. This is what modern monetary theory tries to explain, and it gets viciously attacked because it threatens the narrative. If people understand that government spending is not constrained by tax revenue, that deficits are not inherently bad, that money printing does not automatically cause inflation, then the entire austerity agenda falls apart. You cannot justify cutting social programs anymore. You cannot justify tax cuts for the rich by saying we cannot afford to help the poor. The justification disappears, and that is terrifying to powerful interests. So they fight back with the inflation narrative. They point to Zimbabwe and Venezuela and Weimar Germany. They ignore Japan. They ignore the US from 2008 to 2020. They ignore the role of supply shocks and corporate greed in recent inflation. They keep the story simple. Money printing equals inflation. Government spending is bad. Cut programs. Protect profits. This is how economic propaganda works. Keep it simple. Keep it scary. Keep people ignorant of how the system actually functions. The truth is messy and complicated. Inflation has many causes. Money printing can contribute under certain circumstances, but it is not the only cause or even the main cause in most situations. Supply matters more than demand in many cases. Corporate power matters. Expectations matter. The productive capacity of the economy matters. But acknowledging this complexity makes it harder to push austerity, harder to justify cutting programs, harder to protect the wealthy from criticism. So they stick with the simple story. And it works. Look at what happened during COVID. The government sent stimulus checks to regular people, extended unemployment benefits. Small businesses got support. And yes, the Fed did more quantitative easing. But which part gets blamed for inflation? The checks to regular people, not the corporate bailouts, not the Fed inflating asset prices, not the supply chain disruptions, not the corporate price gouging, just the stimulus that helped regular people survive. That is the target. Because helping poor people is what threatens power, not protecting corporate profits. This is the real function of the inflation narrative. It is a weapon against redistribution. Anytime someone proposes spending money to help people, you can shut it down by claiming it will cause inflation. Universal healthcare? Cannot afford it. Inflation? Free college? Cannot afford it. Inflation? Higher minimum wage? That is just inflation in disguise. Meanwhile, corporate subsidies continue. Military spending increases. Tax cuts for the rich pass without question, because those do not cause inflation apparently. Only spending that helps regular people causes inflation. The game is rigged. The narrative is designed to protect wealth and power while keeping everyone else fighting over scraps. And inflation is just one of the tools they use. Keep people scared of government spending. Keep them believing that helping the poor will hurt everyone through inflation. Keep them ignorant of how money actually works and where inflation actually comes from. And you can maintain a system that funnels wealth upward generation after generation. So what is the takeaway? Money printing does not automatically cause inflation. The relationship is complicated and depends on many factors. But the simple story that printing money causes inflation serves a political purpose. It justifies austerity. It protects corporate profits. It blames the poor for economic problems caused by the rich. And it keeps regular people from demanding the government use its power to actually help them. Because if people understood that the government can afford to help, that the constraint is real resources, not money, that inflation is mostly about supply and corporate power, then they might demand change. And that is what the system is designed to prevent. Thanks for sticking with us through this. Make sure you check out the next video that is about to pop up on your screen. We are diving even deeper into the economic lies that keep you trapped while enriching those at the top. This is Money Trap Channel, and we will see you in the next one.